Actually, for those of you who might not be familiar, if you're familiar with IPD indexes, you may recognise the green. But IPD is part of MSCI now, a wider investment data firm, mostly focusing on equity markets. And the reason I say that is hopefully you can kind of therefore put us into some context, but really because the work that we've been doing has very much been in terms of supporting investors. As you can tell from my accent, I'm from Chicago. The work that we've been doing here has been with the US investors and indeed Canadian investors too. So what I wanted to do is actually show the kind of data in the context of our data, IPD's data, in the context of the conversations that we're kind of having with those investors. So it's actually picking up on a lot of the things we've kind of looked at over the last few hours, and certainly some of the themes have seemed very apposite to the data that we're discussing with those big investors. As I say, big investors, so they're more on the institutional side. The biggest, certainly by value, part of their portfolios are certainly core. So what I was going to do was really run through these kind of three main elements, and as I say, I think they certainly pick up on conversations we've had already. And the first one really is we talked a lot about capital, lots of it, and that's not telling anybody anything new. But I think it's probably worth just sort of seeing this in the context of something that really is truly fundamental and structural. This is not necessarily a reaction to low bond rates. It's not about investment opportunities in any part of the world. It's not about necessarily maturing of real estate as an asset class, but certainly there's this fundamental shift towards alternatives that's been going on for near on 30 years now. So whatever we see, I think we've got to see that in context. So this is not necessarily an ebb and a flow. This is something that's kind of here to stay. And as you can see here, this sort of Towers-Watson study here shows that 25% is the average kind of exposure to alternatives, and real estate very much the sort of the largest part of that. And in terms of, again, we've been talking about appetite, and there's a lot of talk about sort of opportunistic kind of opportunities. I think what's interesting from the sort of the information in Rev survey here is that you clearly see, I guess, a logical reaction. This is certainly something that we felt with our conversations with investors was going on through the post-financial crisis period, almost a kind of an uber risk aversion going on, and a rush to core, and we see all the effect that had on the main markets around the world and pricing and so on and so forth. And actually, certainly, if you sort of see this in the context of the European cycle from the white line, which is our pan-European index, you can kind of see this does seem to be kind of rational reactions to market behavior. But what is interesting is over the last couple of years, the focus more on kind of going up the risk curve. You can kind of speculate on why that might be. Is it because core markets are priced out? Is it more confidence? But starting off, I thought was interesting. It's almost like a logical step through. Firstly into value add, and now the second year of this kind of shift, we see it moving more into opportunistic. So, as I said, this may well be sort of a reaction to kind of market cycle, but certainly, if I were sitting in, I don't know, Montreal or Toronto or Sacramento, these kind of this kind of chart, I think, is probably central to sort of how the investors are kind of thinking about it right now. And to a degree, I suppose it's only recently that I suppose the volume in those conversations has gone up in terms of European markets. So that would be my perspective, at least. And certainly most of the focus and the conversations have been about US performance. Actually, that's even true in the Canadian the Canadian plans. I think they've been able to see that they can get diversification benefits across a very, very wide marketplace without going too far away from home, and they've been getting a great return out of it. But those conversations have changed, and I think they're now part of seeing Europe as an opportunity, and you can, I guess, the relative performance differentials. And it's not, certainly our data, it feels, well actually I know, but it certainly feels like it lags the conversations that I was listening to this morning. It's the values on which the about 2 trillion of real estate investments around the world are held on the institutions' books. So yes, it will lag traded prices. But clearly, they're seeing sort of uplifts in value and momentum shifts starting to come through on those valuations in Europe, and certainly some of the listed market as a precursor of performance in the direct markets is, I think, reflecting that too. So this is particularly the case for, well, Canadians are seeing it now. I think US investors are maybe thinking some of the juice has come out of the market. So, those relativities are presenting Europe as a viable option for them now. Either if they're thinking about it in a sort of a return accretion point of view, or indeed of further pursuing their kind of diversification policy. But perhaps picking up on some of Richard's points, we have actually this is one of the benefits of IPD now working within this kind of multi-asset environment that is MSCI. We've got much greater access to information on listed real estate and on other asset classes, and I think this allows us to sort of start to present the investment opportunities in this kind of risk-return space to investors. So what we've got here are rates of return over different periods, as you can see, for real estate. Actually, this is honed in on Europe, and actually I realise now I didn't actually change the title of this chart, because this was a chart showing global, and it was very much the case that real estate has generated attractive performance relative to equity and bonds, and fits into the spectrum where you'd expect it to be on a global basis. In between equities and bonds, and actually on the efficient frontier if you risk adjust it too. But obviously, if we put this into a European context, say these measures are just for European assets, you see that's probably not so much the case. If you go over the 10-year period, really unlisted real estate is the only class here that's produced a return that's comparable with equities and bonds, and indeed with a high degree of volatility as well. So I don't think you can quite make that case, but that may well be because of course, the fact the last 5 years have been pretty tough in terms of returns. So if you think about it in a global context, clearly the performance of the US market is generating that overall conclusion at the top of the slide. So I think that's probably presenting some kind of opportunity in investors' minds as well about catching the European market at the right point. I think what was also relevant here is perhaps as a little bit of a side point, but picking up on Richard's comments about different ways to access the market. What we see with listed real estate over the sort of, if you look at the 3, 5 and the 2014 performance, I think is something we've seen in other markets as well, which is that clearly listed real estate has done pretty well, REITs have done pretty well over the last period, but perhaps there's a very strong correlation between the bond repricing that's been going on through that period, driving those returns. So that kind of brings us to what are we buying when we're buying REITs, and just again as maybe a little bit of a digression, what our colleagues at MSCI have done produced what they call a liquid real estate index, which is basically taking REITs, core REITs, so separating out the operating companies and deleveraging them. And there's now an iShares fund, ETF fund, based on that index, and work's being done to try and create those models in Europe as well. So clearly trying to get to the kind of the holy grail of a sort of real estate return without out of REITs. So anyhow, just kind of coming back to direct real estate. This is kind of looking at that kind of 2 trillion of investments around the world and about 2,000 assets. Valuation based, but it's clearly showing the differential trends here. And I think what is still interesting is that the US market through 2014 was still very strong, and certainly stronger than the European markets we've been discussing. The UK is clearly the exception. But I thought what was interesting was when we looked at this almost like market by market, was the kind of shift through from offices and at times residential assets kind of leading the way through to really industrial. Now this is basically industrial property around the world, so 13.6% return, clearly the best performing of the 4 main property types. And this happened in actually most countries. Industrials were kind of leading the way. Now you can kind of speculate whether that's going to driven more by economic fundamentals and maybe perceptions of recovery, or it's just working off a much higher yield than other asset classes, and the bond pricing differential is kicking in, and those superior yields just too difficult to resist. But again, from a perspective of some of the conversations we have with investors, I think what people are probably seeing is the momentum generating coming through in Europe. And we're starting to see this from this kind of chart here. Now, yes, if you look at this chart's kind of looking at current return respective to returns over the last 5 years as some measure of momentum. And it's certainly true that the North American cities are certainly still relatively healthy, but some are actually starting to wane, and it's certainly the Canadian cities have been on a very strong cycle. DC was particularly strong in the initial period from the financial crisis, is now weakening. But you can still see that tech-driven San Francisco is very much at the very strong end of the spectrum here. But what is perhaps interesting is the spread around Europe, where we can kind of see some momentum building. Yes, London obviously stands out, but I thought it was actually, certainly as I was listening to the conversations about Spain, interesting to see the strength starting to be demonstrable on the portfolio assets that's that we measure in Barcelona. So I think, again, these investors will be kind of looking at this data, seeing what was sluggish markets and perhaps sort of performance picking up at a time when, actually we can't see the dynamic on this, but I could draw you some arrows, and clearly the sort of the US would be kind of trending down towards the bottom left, whereas the European markets are maybe trending up to the top right. And so just kind of pick up on the last of the three themes. The issue of pricing, and I think we kind of talked about sort of record lows in terms of cap rates and so on and so forth. And I put this chart up for the US as a kind of almost a sort of a benchmark for thinking about other markets. And what it's doing is it's looking at income return as kind of, I suppose, AKA cap rate, and where that is respective to historic averages, and the spread over government bonds on the vertical scale. And look, this is actually telling a very simple story, which of course is that we're close to historic lows in terms of absolute pricing, but on relative pricing to bonds, we're pretty much at the sort of the long run average, which is clearly underpinning prices of US real estate. So, I mean, the question would then come up, where are we with other markets, of course? Well, I think if you try and look at the full spread here, there's a lot of detail, but you would clearly see that the US is down to its historic low. But I think if you go through a number of European markets, Germany, even the UK, in terms of an average across the whole of the assets measured, is not down to the historic low that we've seen, which was, I think, back in 2007. So if you kind of do that comparison as a global investor would do, would clearly see some value and opportunity in Europe, which is, I think, just providing the sort of the stats from our perspective to support some of the conversations we've just been hearing. From a Canadian perspective, you can see, gosh, yes, next to the UK, yeah, definitely, absolutely down to an historic low. And actually a compression that is actually almost halved cap rates over the long run. So a Canadian investor will clearly be looking at that and thinking about relative value elsewhere. And certainly you can take the same kind of analysis on the premium over government bonds, and in this context, either the US or Canada, which are showing similar premium, you'd argue that there's good value in many European markets on the premium side. So I think all this is kind of pointing to, there was lots of, I did note lots of conversation, lots of comments about it's about fundamentals and I'm not worried about the asset pricing, but I think there's certainly a feeling that there's some asset pricing profit to be had, or asset pricing gains to be had from a US or a Canadian perspective.
Morning, what's really driving this, the theme of the REITs business in Spain. I guess, is the tax regime. As I said, you don't have any transfer tax, you don't have any corporate tax, you don't have any stamp duties on acquisitions, and you have only taxation on dividends on the personal investors level, which means on an asset level you basically have zero taxation, including that. And it makes worthwhile maintaining that SPV structure, which obviously is a bit more complicated than having a simple limited company. But that's what's been driving this, and that actually with 30% corporate tax that usually applies, you have huge gains over that, the usual structure, and that helps a lot. And that's what's been driving money, that's what's been driving indirect investments into Spain. Compared to the rest of Europe, what I've seen, what we've heard this morning, for example, from Italy, I think it's not as tax efficient. Germany has suffered a lot. I mean, a lot of entities tried to launch REITs in the late 2000s, or mid 2000s, and it all, I think, went pretty much down the drain because tax regimes, taxation, tax laws simply didn't allow for the same efficiency. And that's very much the question. I think Spain, in that sense, has become a level for a country's own intents and successful intents and attempts to drive the investment in the country. So that's brought a lot of liquidity indirectly into the country. As I mentioned, Soros, Buffett, and so on.
With the government measure that is called Sblocca Italia, that means unlock Italy. And so in Italy we have just 2 REITs. And nowadays there are another at least 4 companies that are going to launch REITs, and so maybe the gap will be closed. Yeah. Coming back to the fund, well, I have to say that nowadays, finally, the institutional investors, also the abroad institutional investors, started to understand how really it works the funds, because at the starting point the threat that was on the funds was about the governance, because given the fact that the funds has to be managed by companies that are governed and are under the authorities, I mean Bank of Italy and Consob, sometimes the perception was that you put money but then you are not able to drive the decision. And so this is something that finally is understood. Speaking about the differences between the listed and the unlisted one, there is a big differences. Again, the listed one is becoming less attractive. My company used to manage 3 listed funds. Now we have 1. The other 2 we have closed, even because the Italian laws is for closed-end fund, and so it's not open-ended fund. And so for the investors, like the US investors, we have a lot of them, and almost everybody prefer to have the unlisted one.
Well, certainly there was a shift away from funds post the financial crisis, and the driving force behind that was a desire to have more control, or actually more control over risks, and I don't think that's gone away. And it's certainly the case for the very biggest investors. That's the kind of the route of choice, and obviously we've talked a lot about JV partners and so on and so forth, and that's the kind of modus operandi for the very biggest. And those platforms are kind of largely in place in many cases. I think what is perhaps interesting is at the smaller end of the scale, there's a lot of smaller funds now, pension funds, that are thinking about expanding outside their domestic borders for the first time, and that's got to be done through funds, and that's generally where those conversations are going. So it does seem to be more about kind of size and maturity than anything else.
Briefly touched the issue of transparency in Spain and those markets this morning. What I find is obviously listed REITs very much help and support the argument of transparency, because there's a requirement, minimum requirement, which actually is bringing these markets in that aspect forwards a lot, and I think that will help future transactions also with those and out of those vehicles, because it's becoming a sort of the standard vehicle in Spain, and a lot of portfolios are converted into REITs, and afterwards it will be much easier and much quicker to sell out of those, because there's much more transparency on an asset level basis.